Hey everybody, today we're going to be doing another dividend analysis, and today we're going to be looking at Smith & Wesson Brands Inc., or simply Smith & Wesson, which is SWBI. I wanted to do this one because a lot of people have been asking me why I in particular like this stock so much, and I will tell you that I do have a relatively large position in this company for multiple reasons, but today we're just going to be going over the dividend. If we start, we can look at the yield. Here, this is not correct because they did just raise their dividend to 8 cents. The actual current yield is about 1.3 to 1.4%, so just keep that in mind. If we look over our history, we can see that they actually don't have a history of paying dividends. Their first dividend declaration was last year during September. We can see it was 5 cents, and they have recently raised it to 8 cents. So you might be asking yourself, okay, why are we going over this stock if we don't really have a history of dividends to look at? And I'm going to explain that as we go along. But with the little history we have, we can see that they have raised their dividend in the short term, so that's at least something good, and they raised it by a decent amount, 60%. So let's look at our free cash flow. If we go to our free cash flow, we can first see that our growth has been pretty stunning. If we go by the trailing 12 months, we went from a loss of $7 million over 12 months to a gain of $293 million in free cash flow. That's pretty amazing. If we look, we can see that the growth has actually been pretty nice. We went to 80 million, 189, still going up. Maybe a little bit, it's slowing a little bit, but when you have such an explosive amount of growth in free cash flow, you can kind of expect that. So we have a 5-year average of about 75 million, but that's really, we can't really go off that because of how much of a change. So for this, I'm going to be going off really the last couple years. And if we look at our ratio of free cash flow to our dividend, we can see that we're only using about 2% of our free cash flow to pay dividends. Before the dividend increase, they paid out $7.7 million of $293 million, so well below our 50% ideal range with plenty of room to grow there. So what does that mean? That means that if they want to raise dividends in the future, they have plenty of room to do so. They could afford, for example, to increase the dividend by 10 times and still be well under our ideal free cash flow. Not saying they should do that, just that if they did, it really wouldn't be that much of a problem unless they had other obligations they needed to do with that free cash flow. So where is that free cash flow coming from? What is Smith & Wesson doing to get that money? For anyone who doesn't know, Smith & Wesson does manufacture guns. That is the biggest part of their business. Everything from revolvers to pistols to rifles. If it's a gun, they make it. They also do branding, like any other company, putting their name on apparel and other things, and they have a few other smaller segments such as survival gear and other stuff. But the main focus of their cash flow, of the money they make, is going to come from firearm sales. So let's go over and see what they're making in terms of income. And if we look at their net income, we can see that over the last few years, we have gone from 127 million up to 252 million. Now this is a bit spotty here. As we can see, they went from 127, then they went down, and then spiked back up last year during the pandemic. It should be noted that they spun off a very unprofitable part of their business in 2020, so that is another reason why their income grew so much. So while their free cash flow did show a really nice increase 12-month over 12-month, their income not as much. It's still an increase, and they still have more than enough room to pay for their dividends out of their income, sitting currently at about 3% ratio of dividends to income, again, well below our 50%. If things continue as they do, they'll have no problem making enough money to pay those dividends. So, seeing all that, what do we know about the company? They've just started a dividend. Are they going to continue to pay that dividend? Is this just a short-term thing? Well, we can see by them raising their dividend by such a large amount relative to what it was before in less than a year that they're definitely looking to raise the dividend. I went through their quarterly reports and I looked at what management said, and management's top priorities are, and I quote, remaining debt-free and remaining cash flow positive. The second part, remaining cash flow positive, is incredibly important to a dividend investor. Not saying that remaining debt-free isn't, but being cash flow positive means that you have cash flow to pay those dividends. When a company says that they want to be cash flow positive and they pay a dividend, you can take a little bit of solace in the fact that that dividend, at least in the company's eyes, is going to be safe. They're going to do other stuff with that cash flow. They're going to do share buybacks like they just announced they're going to do. They might make an acquisition or two, but the fact that they're trying to stay cash flow positive means that they want to be able to pay that dividend over the long term. Now, is that dividend going to grow? Are they going to be able to do that? When I look at this stock, I look at the gun industry, and I look at what's going on currently. We have a current political climate where there are people saying that they want to ban guns whatsoever or introduce gun control legislation. Now, an ignorant, uninformed person might go, oh, well, that means people aren't going to be able to buy guns. Someone who knows anything about the political system, anything about the way guns work, is that when these kind of things happen, gun sales go through the roof, which has happened in the last year. There have been record gun sales for pretty much every company that makes guns. There's been a record number of background checks, and this keeps increasing quarter on quarter. Now, I'm not giving any financial advice, nor am I saying this is going to happen, but if I were a betting man, I would assume that over the next 3 to 4 years, that trend is going to continue. If you combine that with the current political unrest and social unrest, people want guns. They want something to be able to defend themselves, plus you have your legacy customers who are buying for sporting and other reasons. So, is this a dividend stock for you? Is this an income stock for you? Who is this for? If you're an income investor, flatly no. This dividend is paltry. If you're an income investor sitting at less than 1.5%, this isn't going to do a ton for you. However, if you are a dividend growth investor, this might be a way to get in on the ground floor of a dividend growth stock before it really gets up there. Currently yielding at 1.5%, but if these things happen, if the current trend continues for the company, I would expect them to start increasing that dividend year on year. If I saw numbers similar to this year, next year, I would assume a 1 to 2 cent dividend increase annually as long as those numbers continue to go the way they do. I'm not saying that's going to happen, but as an investor, as someone who quote-unquote believes in the company, that's what I would expect if these numbers continue. And if management continues to do what they say they're going to do, keeping debt down, keeping their cash flow positive. As a dividend investor, that's really important to me. I see that and it makes me think, okay, they're really focusing on keeping their investor relations, the way they pay their investors, keeping those things intact. And that's really important especially if you're a dividend growth or income investor. Another side of this is just the value play. I'm only going to go over that briefly. Smith & Wesson, after their last quarterly report, their stock price jumped up. They're currently, in my opinion, incredibly undervalued. So again, if you're trying to get in on the ground floor here of a dividend growth investment, this might be something. Getting a company that's just beginning to declare dividends while they're being undervalued could be a really good payoff in the future. Again, not financial advice, but this stock could double or triple if the current trend continues. Now, I'm a little hesitant on that just because of the industry. Guns are a bit of a social faux pas for some people, so I'm not saying that's going to happen. It's possible, just like with any other stock, but if the numbers follow historical averages, it would make sense. As you can see, they have a PE of 5, where the historical average sits between 15 and 20. And that PE doesn't account for the fact that they have more money on hand than they have total debt, so you have to lower that market cap. That PE gets driven down even lower. So again, the takeaway here is if you're looking to get in on the ground floor of a dividend investment, this might be a really good place for you. The dividend right now isn't very large, but they are showing that they want to be a dividend company and will possibly be raising that dividend in the future if they do what they say they want to do. So if you're a dividend growth investor, or you're just looking for a company with some growth potential that also pays a dividend, this could be a really good choice for you. Thank you for watching, and I'll see you next time.